A lot of people think their brokerage cash automatically earns the rate. If interest rates are high, your idle cash must be high too. But in a lot of accounts, that's not how it works. Your cash can be sitting in a default cash sweep that pays surprisingly little, and the only clue is one tiny line in your account details. By the end of this, you'll be able to answer three things fast: where your brokerage cash is actually parked, what it's earning right now, and what the trade-offs are if you change it. Here's the real-world version. Say you're holding $25,000 for a down payment you want to make in about 6 months. You park it in your brokerage because it feels safe and convenient. You assume it's earning something like 4% because you keep hearing cash yields in that neighborhood. 6 months pass. You look back and realize your cash earned closer to 1%. That's not a market crash. That's a settings issue. Most brokerages have a cash sweep program. Sweeping just means idle cash gets automatically moved into a default place. Sometimes that place is a bank deposit program. Sometimes it's a money market fund. Those are not the same thing. A bank deposit sweep is your brokerage placing cash at partner banks. You get interest, but the rate is set by the program. It can lag, and it can be much lower than the yields you see in headlines. A money market fund is different. Your cash sits in a fund holding very short-term, high-quality debt, often government bills. Its yield tends to track short-term rates more closely. But it is still a fund, so you may have to sell shares to move cash out. Here's why people miss it. Your account value looks normal either way. The yield difference is silent. There's no alert that says you're earning 1%. So let's do the simple math on that down payment cash. $25,000 at 1% for a year is about $250. For 6 months, call it about $125. At 4% for a year, it's about $1,000. For 6 months, call it about $500. That gap is roughly $375 over 6 months. On $50,000, it's roughly double. Not life-changing, but it is real money for doing nothing. Now, this is not a do this video. Different cash parking makes sense for different timelines and access needs. The goal is to understand the menu and the hidden cost of the default. Decision rule number 1 is about time. If the money has a job in the next 1 to 6 months, access and reliability matter most. If the money is truly idle for 6 to 18 months, yield matters more, but only after you understand how fast you can get it back. That's the second piece people overlook. Liquidity is not just, can I sell? It's how long until the cash is usable. Some default sweeps act like instant cash. Some money market funds settle in about 1 business day, sometimes 2. For a down payment timeline, that may be totally fine. For, I need this today, maybe not. Now, the common mistake. People search money market yield, see a big number, and assume that's what they're getting. But your yield is tied to your specific cash vehicle, not the market in general. So, what do you check? You need 3 items. 1, the name of the cash vehicle. 2, its current yield. 3, whether it's a bank program or a fund. In most brokerages, there's a cash management page or a positions detail line. If the position looks like a fund, often with a ticker-style name, that's a clue it's a money market fund. If it's a bank program, it usually lists 1 or more banks. Once you find the vehicle, look for the yield. If it's a fund, you'll often see a 7-day yield. If it's a bank program, you might just see an interest rate. Now, add one more practical step. Do a spread check. Compare your sweep yield to one reference cash option inside the same brokerage, like a government money market fund. You're not hunting for perfection. You're hunting for, am I close or am I way off? If you're off by 2 percentage points, that's a real cost. On $25,000, 2 percentage points is about $500 a year. And the longer cash sits, the bigger the quiet drag. Now, options in plain English. Option 1, leave cash in the default sweep. Upside, simplest, often the most instant. Downside, the yield can be meaningfully lower. Option 2, manually move cash into a money market fund. Upside, the yield often tracks market rates more closely. Downside, you must understand how to sell it and how long it takes to become usable cash. Option 3, keep cash outside the brokerage in a high-yield savings account. Upside, straightforward, clean separation from investing. Downside, transfers can take time, and you have another account to manage. Notice what matters. timeline, access, and your tolerance for a one-time setup step. Let's come back to the down payment example. In month 5, they start mortgage paperwork. That's when predictability matters. A money market fund can be predictable, but only if they test the move early. A savings account can be predictable too, but they need to know transfer timing. Decision rule number 2. Never wait until the week you need the cash to learn how your cash moves. Run a small test now. Move a tiny amount, then move it back. You're buying certainty. Now, let's set up the what to watch next signals. You only need 3, and they're all visible in your account. Signal 1, your sweep yield. Where to look. Cash management or the cash position details. What it means? If it's far below comparable cash options, you're paying opportunity cost. Timing, check monthly and anytime rates are moving a lot. Signal 2, your cash vehicle name. Where to look. The cash position label and any account messages about cash programs. What it means, if the vehicle changes, yield and liquidity can change with it. Timing, check after brokerage policy updates and after opening new accounts. Signal 3, your usable cash timing. Where to look. Transaction history for a sell order and the cash availability date, plus bank transfer history. What it means, if it takes 1 to 2 business days to get cash out, build that into big purchase timelines. Timing, test once a year, and again before a major purchase window. Estimated total words, target, 1530. Estimated runtime at 170, WPM, 905. This chunk word, count, 416. Cumulative words so far, 1543, target 1530. Quick recap, in one breath. Brokerage cash is not automatically earning the rate. It's earning whatever your sweep vehicle pays. And the difference between a low-yield sweep and a competitive cash option can be hundreds of dollars a year on normal balances. One more pass on the down payment example, because this is where timing matters. If that $25,000 sits for 6 months at 1% instead of 4%, the rough gap is about $375. If you discover that the week you need to wire funds to closing, you can't fix the past. But if you discover it in month 1, you can make an informed choice and still keep the money liquid enough for your timeline. Also, don't ignore taxes just because it's cash. Interest is still income. If your cash starts earning meaningful interest, expect it to show up on a tax form. That does not make it bad. It just means the net benefit is a bit smaller than the headline yield. Now here's your 2-minute checklist. First, find the cash vehicle, open your cash management page or your positions list. Read the exact name of the cash position. Second, classify it. Does it look like a bank deposit program, often listing partner banks? Or does it look like a money market fund, often with a fund-style name? Third, find the yield. Look for the current interest rate, or the 7-day yield if it's a fund. Write down the number. Fourth, do the spread check. Compare your yield to one reference inside your brokerage, like a government money market fund. If you're more than about 2 percentage points lower, that's a meaningful drag. Fifth, test liquidity. Move a small amount out and back. Time how long it takes until the cash is usable. That tells you whether it fits your timeline. Sixth, check the auto behavior. If you move cash into a fund, confirm whether your brokerage automatically sweeps dividends and sales proceeds back to the same place, or if it drops into the low-yield sweep again. And finally, align it to the job. Down payment in 6 months, prioritize predictable access. Idle cash for longer, weigh yield versus the one-time setup and settlement timing. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. And leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.